Welcome everyone to our presentation on Citicore Energy REIT, the Philippines' first energy-based real estate investment trust company. The company is eyeing to list on the Philippine Stock Exchange's main board with a target to raise up to 6.17 billion Philippine pesos. This morning we'll be presenting to everyone the CREIT IPO overview, business model, the revenue sources, the company structure, their existing portfolio and expansion plans, and some key risks and what we like about CREIT. So on an IPO overview, the company name is Citicore Energy REIT Corporation. Ticker symbol will be CREIT. The offer is going to be comprised of 2.5 billion common shares, comprising of 1 billion primary shares and 1.1 billion secondary shares. And up to 327 million in over allotment option shares will be secondary shares as well. It will be offered at an offer price of 2.55 pesos per share. The offer period is running right now from February 2 to 8. Total proceeds to be raised, assuming the over allotment option is exercised, will be 6.39 billion pesos. And the listing date is on February 17, 2022. So the overview of Citicore Energy REIT Corp. So let's first talk about the business model of CREIT. It's a unique investment to the Philippines' first energy-based real estate investment trust with the green revenue sources. Green revenue sources refers to the fact that they are in the solar power industry, which means they get power from the sun. And this means that there are no carbon emissions from it, making it a green revenue source. So the way it works is that CREIT is a REIT company. Okay, it's not a power company. It's still a real estate company. CREIT's tenants, which are the power generators, enter into an offtake agreement with its customers, the government and/or private companies, for the sale of its generated power. Then, from these tenants, CREIT receives property lease payments for its power generation tenants in the form of guaranteed annual rental rate and variable rental rate. We'll go more into that later. The sponsor, Citicore Renewable Energy Corp, receives dividends from CREIT with its equity stake, along with the dividends that's distributed to the public. As the public gets the dividends, CREIT will use the dividends that they receive to develop solar power plants that will be later on infused into CREIT after the plants establishes a proven track record. Okay. So these are the revenue sources. So power of the sun. You get the guaranteed annual rental rate for the leased properties, which is what we talked about, and which is what is standard in the REIT sector. So the tenants pay a base lease agreement for the space that they are leasing. For the property sector, that would be offices or retail spaces. But for the case of CREIT, these will be power generation companies. So what they're actually doing is they're leasing the land of CREIT to put their solar power plants on so that they can generate power from which they will make money, and they will pay CREIT a guaranteed annual rental rate. Now, the next one is the variable rental rate. So let's just define it quickly. It's equivalent to 50% of the incremental gross revenue earned by the lessee from any excess of its actual generation for the current fiscal year over its base revenue. Simply put, the VRR here is if the power plant is able to generate extra power for that fiscal year, then it will trickle down into the dividends. The way it will work is that the GARR will be the basic dividends that you'll be receiving, like on a quarterly basis. And then at the end of the year, there's a special dividend. It will be comprised of the VRR. Now, the VRR is something that we really like. It's because it's unique in the REIT sector. There are no other REITs that have variable rental rate. All the other REITs have guaranteed annual rental rate for the leased properties. Just to give you a better idea, so we've broken down CREIT's cash flow diagram. So on the left side, first, we are looking at the customers and off-taker sides. They're the clients. So the customers enter into an off-take agreement with the solar power plant operators and pays tariff for the power received. On the next step, there's the solar power plant tenant operator. So they're the ones receiving tariff rates for the power that they produce to the customers and off-takers. In the form of dividends, the money will flow up to Citicore Energy REIT Corporation. Not yet in the form of dividends. The money will flow up from the power plants operators to CREIT as payments for lease and the VRR. And then from CREIT, it flows up to CREC and the public. Here, we see that CREC receives dividends for 62% ownership of CREIT, whereas the public will be 38% of that. So CREIT receives property lease payments from power generation earnings from the guaranteed annual rental rate and the variable rental rate. That's how the funds will flow from the customers to the solar power plant, to CREIT, and to the public, and to CREC for them to be able to develop their power projects. This is one of the things that we like about CREIT. Their tenants and off-takers. Here we show on the left side their customers. Transco, the National Transmission Corporation, accounts for 27% of their contracted capacity, and that's because they have a fit rate. 73% of that goes to diversified conglomerates, and one of the strong ones that we see here is ASEN and Shell Energy. On top of that, we like Freeport Area of Bataan and Ecozone Power Management Incorporated because they're industrial park operators. So we're quite confident in their demand for power. On the right side, we show the total installed capacity for CREIT's tenants and the breakdown of their power produced. 95% of their power is contracted to these contestable customers, and only 5% is sold under priority dispatch on the West M. What we like about having the contracted power is because it assures CREIT of stable recurring incomes. Other solar plants without off-takers have to deliver to the grid where they're exposed to changing prices and changing demand. For CREIT, only 5% is exposed to the open market with the wholesale electricity spot market. One thing that we also like about them is their solar plants operation. If you look here on the green side, the ones showing 98%, 97%, that's the availability ratio. The availability ratio is the time that they're available to deliver power to the grid. And in this case, for the past 5 years, they've been able to deliver power to the grids for 98% of that time in their operations. Another high percentage we see here is their performance ratio. Performance ratio is simply the theoretical capacity of a plant. So for example, if you have 100 megawatts and then 85% is your performance ratio, or at least for this case, the average performance ratio across all the plants on the board is 83%. It means that they're able to give out 83 megawatts of power based on the theoretical 100. And we like that they're able to do that at 83.3% because that's pretty high for the solar industry. Another thing that we like to note here is that if you look at the numbers, there's not much deviation between all of the figures, 98% for the past 5 years. And this is spread across all their 7 plants. If we look at it on a breakdown basis, there's not a lot of deviation. We'll get some 82% and then 85%. And it's owing to the company's setup where they've been able to install, they've been able to digitalize their management of the plants, allowing them to be able to monitor their plants from a control room, despite having all their plants spread across the Philippine archipelago. Now, what does that mean? Having that ability to be able to monitor their power plants means that they're able to see whenever something needs maintenance on a single solar PV unit base. So even if, for example, even if the one solar panel goes down in South Cotabato, they're informed here. They're able to contact their ground crew maintenance there, and they're able to react effectively. And that's one of the things that we like about them because with their plans to expand to several more plants towards the future, having this type of management and reaction time to being able to continuously give consistent numbers on your performance metrics is very good. And here we discuss the use of net proceeds. So for the primary offer, for the primary shares, there'll be 2.55 billion Philippine pesos, 41% of the offer. The secondary will be 59%, the 3.62 billion, for a total net proceeds of 16.17. The primary proceeds will be issued by CREIT. And the primary proceeds will be used to acquire the properties owned by Citicore Bulacan Incorporated and Citicore South Cotabato. So right now, they have 5 power plants in the portfolio. It has 123 megawatts. They'll be adding another 21.7, bringing it around 145. And that's going to be coming, okay, here, 21.2. These are the two properties to be infused. For the secondary share sale, it will be going to CREC to develop what you see here of the reinvestment plan, where there are 10 solar projects that we're looking at for a total capacity of 634 megawatts. Okay, one thing we want to note here, we've been getting this from investors, and it's been a worry to some investors because of there's a huge portion of the offer that will be a secondary share sale. I think okay, if you consider a common IPO where it is not a REIT vehicle, it is a company trying to list on the PSE. And if you look at their offer shares, and it's comprised largely of secondary share sales, where the secondary share sale selling shareholder is parts of the are the owners of the company, then that is a worry, because what happens is you're investing in an IPO where only a small part of your investment will go to the company for its expansion purposes, and then the rest goes to the owners, where you don't have any control anymore on where it will go. For the case of REIT, for REIT's investment, the standard has really been a secondary share sale, and that's because the implementing rules and regulations for REIT vehicles is that the selling shareholder or sponsor must submit a reinvestment plan to the SEC and the PSE that backs what they will be using the secondary share proceeds from. Okay, so simply this means that the CREIT in this case, as a selling shareholder, whatever proceeds that they'll be raising from this public offer, they will have to reinvest it here in the reinvestment project pipeline that you see here, which are targeting 634.5 megawatts. Okay. So post-offer structure of the CREIT will be this. CREIT Renewable Energy, Citicore Renewable Energy Corp, or CREC, will own 61.7%, and that's going to come from the part of it is going to come from the secondary share sale. The public shareholders will own 38.3%. Again, so whatever secondary share proceeds that will be going to Citicore Renewable Energy Corp in this matter, for the purpose of REIT vehicles, they're to be reinvested into a pipeline. And here we look at the relative valuation table. I'll walk you guys through it. This is a little bit of a handful. Basically, here we look at the comparable companies of CREIT. And what we've done is we've selected all the REIT companies that are currently listed in the Philippine Stock Exchange. And we've also chosen two from Japan, Japan Infrastructure Fund and Renewable Energy Japan. So we then got the market weighted average to show you an idea of where the industry is at. So at least for the REIT sector, including the renewable energy companies, energy REITs, sorry, in Japan, for example, their PE is 20 for 2022 is at 22 times. Citicore Energy REIT Corp is at 6. It's only at 15 times PE. So that implies that it's coming off as a discount to the market right now. It also moves on to the 2023. So at the offer price of 2.55 pesos, the PE, forward-looking PE for 2023 is at 16.1 times compared to the 20 times, 0.7 times that the market is right now commanding as a premium. One way to just interpret this and to use this, if you're looking at if you're able to get a 2.55 at 15 times and the market is pricing it at 22 times, then that's a good idea for you to be able to look at what your potential returns could be. On the ROE side, the return on equity, they're also high performers. Market weighted average for the industry is at 17.9 times, 17.9% and 20.3% for 2022 and 2023. For Citicore, they outperformed the industry at 27.8% and 29.1%. And lastly, one thing that we really like about CREIT is the dividend yield. Here we show that 2022 E and 2023 E will have dividend rates of dividend yields of 7% and 7.4%. This largely outperforms the industry with a market weighted average of 5.2% and 5.3%. So we've also analyzed the company with consideration of the risks that can happen to them, which may keep us from prospective returns. So one risk that we've identified is the limitations on the use of leverage. Under the REIT law, REIT companies have a limit on leverage, and they're only able to borrow up to 35% of the value of their deposited property. So when we see that there's limitations on the use of leverage, unlike unlike non-REIT companies where they're able to basically borrow as much as they could as long as they're able to maintain a good debt to equity ratio. For REIT companies, the implementing rules and regulations of REITs limits the use of leverage. So we identify this as a risk with regards to their expansion plans. If they're not able to borrow as much money, how do they plan to expand? How do they plan to pursue their expansion plans? One of the things that we found out about the company is that as of September, they've been already able to pay down their debt. So they're completely unlevered. They have no debt, which means that there is that entire 35%. There's that entire 35% that the company can use. On top of that, once they've utilized the 35%, they can also tap the public markets later on a follow-on offering to be able to raise more funds when they want to acquire more properties to infuse into CREIT. And at the same time, if there are any funding gaps, there's an asset for share swap that they'll be doing. So at least for the limitations of use of leverage and how they plan to expand, we think that they have themselves covered. On seasonal weather changes. Okay. So this one, solar panels are very susceptible to seasonal weather changes. So in the case if it's too cloudy, or if there's a typhoon like Odette, for example, one of the things that they've done to be able to mitigate seasonal weather changes is to mitigate the risk of concentration risk. Okay, so they didn't just place their power plants in one place. They've spread it across the Philippine archipelago, from the top of Luzon to Visayas in Mindanao. So that's one of the ways that they were able to mitigate that risk. In the case of Typhoon Odette, their Silay and Toledo plants were damaged, but only Toledo was really damaged, according to the company. And according to their reports, only 1% of their total solar capacity was affected during that time. And that for us is one of the things that yields positive prospects on how they did their site selection. So on top of looking for the irradiance, by the way, irradiance is the amount of sun on an area that helps you produce power, which is an important metric for power plants, solar power plants. What they've done is, instead of just chasing irradiation figures, they've also taken into consideration seasonal, the weather patterns here in the Philippines, so that they've been able to situate their power plants across the Philippine archipelago to mitigate this. On top of that, and this one simply mitigates the risk on top of everything that they've been doing. Should another typhoon hit and should really damage a plant heavily, they do have business interruption insurance, and they also have insurance on the power plants themselves. So the next risk we've identified is the delays in the implementation of the reinvestment plan. So right now, CREC, its parent, is building 10 power plants. While they're building it, there could be delays as they try to infuse it, and there's a risk that it may affect the value of the company. Well, on USI research, we approached first the analysis of the company without the reinvestment plan, and even without that reinvestment plan, we found that value to be of good value, in line with what the value is currently being offered now. So for USI research, when we look at the future prospect of the reinvestment plan, based on our outlook, even if there are delays for the infusion and the reinvestment plan, it does not currently affect our current fair value that we're looking at for CREIT. Additionally, what we think is now, since we started with our base analysis where we didn't account for any infusions, where we said that even delays wouldn't happen, there just wouldn't be any power plants. Any power plants moving forward to be infused will only bring up the value of CREIT from our perspective, from our base scenario of just considering the 7 plants. Okay, and then lastly, the majority of the land holdings are leased. So 4 of the 7 properties are under sublease agreements, and that presents some key risks to rental rate escalations later on and failure to renew lease contracts. Of the 4 leased properties, 2 of the properties already have or are do have a right of first refusal on those properties. So there's only 2 more that do not currently have. We've asked this, we've asked this to the company, and their answer is that number one, they're confident in the renewal later on because of sustained power demand. They don't expect demand to go down anytime in the future for the next 20 years for power demand. And that they've also done a lot of corporate social responsibility activities with that when they go into when they've set up their power plants where they're leasing, they're also trying to improve the lives of the community that they're in. So at least for the majority of the land holdings being leased, when we look at it on the long-term horizon, by the way, the weighted average lease expiry of CREIT is 20 years. So when we look at the renewal, that's 20 years from now. The current average of the REIT sector right now is at 6.82 years, I believe. Oh, so one more risk that we wanted to discuss here that we didn't put there. So there's a case against the officers of Megawide. And these officers are the same officers that are in CREIT. So that has posed a risk to key man risk for them that if the case is unfavorable to CREIT's management, then there would not be any leadership. Upon discussion with the company, for them, they think it's a nuisance case. They think that there's not much merit on the case, and they're confident that they followed the rules when they did the Cebu Mactan Airport for regards of for regards with Megawide. One thing on an analyst perspective that I find in their explanation to be have a lot of merit in the outlook of this case. During the time that they were doing the Cebu Mactan International Airport, they had to syndicate a loan from ADB and several other big banks here in the Philippines to be able to get funding to build that airport. And each of those 7 banks will do a very stringent due diligence process on Megawide at that time, and they all passed that, and they were all able to get funding. So if you're looking at 7 layers and 7 layers and 7 repetitions of review and due diligence on the company, and at that time they passed, that's where we find they have the most merit in their defense against the prospective overhang of the case on them. Okay. So we'll go into investment highlights, and these are the things we like about CREIT overall. So they have an established track record. They have 5 in the portfolio. They already have 5 existing plants that have been operating since 2016. One of those 5 plants have a fit rate. They have a VRR, which is a very unique income stream. Basically, as power contracts go up for them towards the future, there could be a bigger VRR. So that is one of the drivers for that is one of the potential drivers for the dividend rate later on. They have secured offtake agreements, as mentioned, the fit rate with Transco, and we like the stability of having that rate with the government, as well as the private customers that they have is ASEN and Shell Energy Philippines, and we're confident in their power demand. Additional 21.2 megawatts secured with the FIT. This will be the 2 plants that are going to be infused from AFPO's listing. So in line with established records, these 2 plants have a FIT rate also, they've been operating since 2016. So if we look at the entirety of the portfolio post listing of 7 plants, they'll have 7 plants that have been operating for now at this point 7 years. Next is with regards to the future of CREIT. CREIT with a quality pool of potential acquisitions to choose from. And this comes from the reinvestment plans of 634 megawatts. The way it will work for their acquisition, CREIT fund managers will decide from the reinvestment plan. Okay, sorry, let me just repeat it again. In the reinvestment plan, CREC, the parent, will complete these plans. And when they complete these plans, they'll let it operate for a year so that these new plans are able to establish a track record for at least 1 year. It is then that CREIT can decide when to infuse it into CREIT so that it would improve the value of CREIT and it would also help sustain the dividend yields that they're giving out. What we like about it, why we think it's quality is because it's its own parent developing these projects for CREIT. CREC is developing these projects specifically for CREIT to choose from. So we think that on top of you might have other power generation companies, and they'll have to look to third parties to be able to acquire properties. In the case of CREIT, these properties are being developed within the group and being laid out for them. And then on the longer term scale, a target 1,500 megawatt installed capacity. So with the 634, there's another around 700 megawatts that they're trying to that the Citicore group is working on developing. So what we have here is for the reinvestment plan, we have 10 projects that they're trying to that they're working to develop so that they can infuse it later on to CREIT. And on top of that, which they are still currently working on, they have a target to reach 1,500 megawatts of installed capacity for the future. So at this point where we've looked at the valuation of CREIT, and we've only just our base case scenario only values the 7 properties, with the 5 existing, with the 2 to be infused post listing, and then they have the 634 megawatts that they're currently already working on, and with a longer term target to 1,500 megawatts. What we like about this is that CREIT's future is being laid out by its parent company. So in line with this, we just want to go a little bit into investing in REITs. So why do we like investment in REITs? It empowers investors to pool their money to fund and own a portfolio of income-producing accretive assets that generate stable income. So where we look at generating stable income, that's from stable recurring cash dividend income. As you know, that the rates that are coming out right now for REITs at 5% and at 7%, it's somehow outperforming the pref shares that we've seen being listed back in 4 or 5 years ago, pre-pandemic. Again, one thing I wanted to note, REITs were also born during the pandemic. The first one was listed in 2020 by Aguila, and and one of the reasons why it's garnered a lot of investor interest is because it is a very defensive stock. You're able to maintain a cash flow from the dividends. At the same time, there's also a growth side to the stock value appreciation of the REITs. And that's where we look additional potential of stock price appreciation. As companies infuse properties into the REITco, the asset value of the REITco goes up. And that's why later on we'll look that most of the REIT assets have been going up. But before that, we want to highlight a little bit more. High dividend yield hedges inflation. Yes, it's an inflation beater with its high dividend yield rates. Liquid investment to real estate assets. Yeah, it's still a stock, so you're able to sell it as a very liquid equity investment vehicle. The properties are managed by experienced professionals. So to every REIT company, there's always a fund manager and there's always a property manager. And the property manager makes sure that the properties are well maintained, and then the the finance managers make sure that the properties are always able to produce a stable recurring income that will go into dividends. And lastly, as we said, with regards to the secondary share sales and the fact that the REIT law requires the parent or the sponsor to submit a reinvestment plan, and which is monitored on an annual basis, it is a transparent investment. They will show when they've been able to infuse. They will show when they're the progress on their power plants moving forward. And here is just a really quick summary. This is the REIT sector of the Philippines. We have A-REIT, DDMPR, PhilREIT, RCR, and M-REIT. If you look on the right side, we've highlighted some figures. For A-REIT, the dividend yield is 4.1%, DDMPR 6.4%, PhilREIT 6.1%, 5.4% for RCR, M-REIT 4.9%. But here's where we also like to highlight one of the best things that we've seen about the REIT industry since IPO change. No? Since IPO, A-REIT has appreciated an 87.6%. PhilREIT 8.7%, RCR 30%, RMREIT 39.8%. Only DDMPR was the one that had decline, and that's owing to most of their tenants being POGOs. So when the pandemic hit harder, a lot of the POGOs left. So right now, it's more of a tenant profile problem than an industry problem. And that's what we like about REITs here, because unlike a pref share or a bond, you get a dividend yield on an annual basis. But every time, for example, a REIT or MegWorld, if you've been reading the news, they've been infusing more properties into their REITs. The value goes up, and that's one of the primary drivers of the value for the stock price on top of the dividend yield. And I guess for CREIT, one thing that we like to highlight, especially, we've discussed this on the RV table earlier on the dividend yield potential at 7%, it will come out to be the highest in the current REIT sector in the Philippines. That is it for our presentation. Thank you for listening.